Welcome to our channel. Today, we're diving into the fascinating world of accounting cycles. Whether you're a student, a small business owner, or just curious about how finances work, this video will break down the accounting cycle into easy-to-understand steps. So, grab your notebooks, and let's get started. First things first, what exactly is the accounting cycle? The accounting cycle is a series of steps that businesses follow to track their financial transactions and prepare financial statements. Think of it as a roadmap that guides you from the initial transaction all the way to the final reports. It ensures that everything is recorded accurately and systematically. This cycle is crucial for maintaining transparency and accountability in financial reporting. Now, let's break down the steps involved in this cycle. The first step in the accounting cycle is identifying transactions. This involves recognizing any financial event that affects your business. It could be sales, purchases, expenses, or any other financial activity. Make sure to document every transaction, as they will form the basis of your financial records. Remember, accurate identification is key. Next up is recording transactions in the journal. This is where you'll log each transaction chronologically. You can use accounting software or a manual ledger for this step. Each entry should include the date, accounts affected, amounts, and a brief description. This step is crucial because it ensures that all transactions are captured accurately. Once transactions are recorded in the journal, the next step is posting them to the ledger. The ledger is where you categorize all transactions by account. This helps in tracking the balances of each account. Think of the ledger as a summary of all your financial activities. It's essential for preparing financial statements later on. After posting to the ledger, it's time to prepare a trial balance. This is a summary of all the account balances, and it helps ensure that your debits equal your credits. If the trial balance doesn't balance, it indicates that there may be errors in your recording or posting. So, double-check your work. Now, let's move on to adjusting entries. At the end of the accounting period, you may need to make adjustments for accrued or deferred items. This ensures that your financial statements reflect the true financial position of your business. Adjusting entries are crucial for adhering to the accrual basis of accounting, which states that revenues and expenses should be recognized when they occur, not necessarily when cash is exchanged. With all adjustments made, it's time to prepare financial statements. The main statements include the income statement, balance sheet, statement of changes in owner's equity and cash flow statement. These statements provide valuable insights into your business's performance and financial health. They are essential for stakeholders, investors, and management. After preparing the financial statements, the next step is closing the books. This involves transferring temporary account balances to permanent accounts, resetting the temporary accounts for the next accounting period. Closing the books ensures that you start fresh for the new accounting period, ready to track new transactions. Finally, we prepare a post-closing trial balance. This is a list of all the permanent accounts and their balances after the closing entries have been made. This step confirms that the books are in order and ready for the next accounting cycle. It's a great way to ensure everything is accurate before moving forward. And there you have it. The accounting cycle is a systematic process that helps businesses maintain accurate financial records. By following these steps, you can ensure that your financial reporting is reliable and transparent. Thank you for joining us today. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more educational content. Have questions? Drop them in the comments below, and we'll be happy to help. Until next time, take care and bye-bye.